When markets crash, portfolios burn unless you understand the invisible string tying your assets together. Millions of investors blindly believe that stocks and bonds balance each other. But that belief is crumbling fast. The stock-bond correlation is no longer your safety net, it might be your silent assassin. This isn't just theory, it's a war plan for survival and success in chaotic markets. Learn how the wealthiest investors adjust their portfolios while others panic. My name is Pablo, and in this video, we'll take a look at 18 shocking, essential truths that could save your financial future. If you like this type of content, don't forget to like and subscribe as I post new videos every week. Okay, let's do this. 1. The stock-bond safety net is ripping apart. According to BlackRock, the stock-bond beta is now the highest it's been in over 15 years. What used to protect you might now betray you. The old rule, stocks fall, bonds rise, is breaking. And if you're still following outdated strategies, your diversification is already in danger. 2. Inflation is attacking both sides of your portfolio. According to the Bureau of Labor Statistics, inflation hit a 40-year high at 9.1% in 2022. When inflation rises, both stocks and bonds bleed. Your safe assets might be quietly losing value while you sleep. 3. Positive correlation is a silent killer. The Wall Street Journal says that stocks and bonds showed a 0.76 correlation during Q2 2022. That's dangerously high. When both fall together, your portfolio has nowhere to hide. Don't wait for the crash to find out you're exposed, for economic cycles demand tactical shifts. Investopedia says that during the 2008 crash, the S&P 500 dropped 38%, while treasuries rose. When fear floods the market, bonds often surge, but only if you shift early enough. Most investors react too late and pay the price. 5. Rolling correlation reveals hidden trends. CFI Institute says that a 36-month rolling correlation analysis shows consistent long-term shifts. Use rolling correlation to see the cracks forming before others do. This is how pros dodge crashes while rookies take losses. 6. Risk on versus risk off. Know which side you're on. The CBOE Volatility Index says that the VIX jumped 94% in March 2020 during a major risk-off pivot. When the mood shifts from greed to fear, fortunes are lost in hours. Know the signs or be blindsided. 7. Bonds are the last lifeline in a crisis. Yahoo Finance says that in March 2020, long-term Treasury ETFs like Gilt gained 15% in 2 weeks. Smart investors flee to quality. If you wait until everyone else does, you're already too late. 8. Risk parity isn't just a strategy, it's survival. CERN says that risk parity portfolios had 60% lower drawdowns in past crises. Don't just balance your portfolio, engineer it to absorb chaos. 9. The Fed doesn't care about your portfolio. According to Reuters, the Fed raised rates 11 times between 2022 and 2023. Monetary policy shifts wipe out unprepared investors. Track it or get trampled. 10. Commodities become kings when inflation rules. World Gold Council says that gold surged 24% during the 2008 crisis. When everything else burns, gold often glows. Make room for hard assets before the storm hits. 11. Long duration equals long pain. According to FINRA, a 1% rise in interest rates can cause a 10% drop in long-duration bond values. High-duration bonds are ticking time bombs in rising rate environments. 12. Macro hedge funds know something you don't. The Man Group says that hedge fund CTA strategies returned 27% in 2022 amid market chaos. They follow the data while most investors follow emotion. Time to think like them. 13. Real yields tell the real story. The Federal Reserve says that real yields turned positive for the first time in years in 2023. Nominal returns lie. Inflation steals your real profits. Don't let the numbers fool you. 14. Yield curves scream recession. Are you listening? The New York Fed says that the 2-year versus 10-year curve inverted in July 2022. Historically a 100% recession signal. Ignore the yield curve at your peril. It has never cried wolf. 15. Rebalance or regret. According to Morningstar, quarterly rebalancing improves returns by 0.4% annually. Set it and forget it? That's how portfolios decay. Real investors tweak, shift, and evolve. 16. Scenario models reveal the future. The CFA Institute says that backtests using stress scenarios reduce portfolio risk by 32%. If you don't simulate crisis scenarios, you're not investing, you are gambling. 17. Some sectors shield you from the storm. The S&P Global says that consumer staples outperformed the S&P 500 by 12% during the 2020 crash. Utilities, healthcare, staples, boring, maybe, but they're your portfolio's body armor. 18. Gold, your wild card when nothing else works. According to research affiliates, a 5-10 gold allocation reduced max drawdowns by 20% historically. Gold doesn't follow the rules, and that's exactly why you need it. The last thing I'll say is that markets are changing fast. What used to protect you is now a threat. But knowledge is power, and you now have the blueprint to survive and thrive. Track correlations, adjust for inflation, hedge with commodities, and gold rebalance like clockwork. Think like a hedge fund, even if you aren't one, the choice is yours. Ignore the hidden link between stocks and bonds, or master it before it's too late. Thanks for watching. I really appreciate it. See you on the next one.